So if you have like petabytes of data sitting in Amazon Web Services right now, or, Google Cloud, you are essentially operating under a financial hostage situation.
Oh, absolutely.
I mean, they charge you literally pennies to bring your data into their ecosystem, but the moment you try to move that data out, like to a different provider or to your own on-premise servers, anywhere really, they hit you with these massive egress fees.
Right, the egress taxes.
Exactly. We were talking about networking taxes that can run into the millions of dollars. It's this artificial gravity designed to just keep your business trapped.
Yeah, and it is, one of the most compelling infrastructure shifts we've seen in maybe the last decade.
Right.
Because the legacy hyperscalers, they built their entire moats on those egress fees, right?
Totally.
They assumed enterprise customers would just never have the leverage to leave. But then the explosion of AI workloads completely inverted that dynamic.
It broke the model.
It did. The sheer volume of data required for training generative models, it's forcing developers to actively seek out independent, specialized storage providers who champion what we call architectural freedom.
Welcome to This Talk Ticker's Deep Dive. We are going to cut through the noise of corporate earnings today and figure out exactly what is happening under the hood.
Always a good time.
Right. So our mission today is to break down Backblaze's second quarter 2026 earnings call. For those of you tracking along, the ticker is BLZE.
BLZE.
We're going to give you the data-forward headline numbers, dissect the underlying business mechanics, and determine if the story playing out here makes this stock, a buy, a hold, or a sell.
And we have a lot of ground to cover today.
Oh, we really do, because this is no longer just the consumer backup utility it was back at its IPO. Like, they are fundamentally attempting to rewrite their DNA into a core pillar of the global AI infrastructure stack.
Which is, an incredibly difficult pivot to execute, especially in this 2026 macroeconomic environment, right? Enterprise infrastructure budgets are facing immense scrutiny right now.
Oh, for sure. Everyone is tightening their belts.
Right. You don't just get to declare yourself an AI infrastructure player. You really have to prove it with the unit economics and the actual enterprise contracts.
Okay, let's unpack this, because the numbers they just reported demand some serious analytical scrutiny.
Let's do it.
I want to start right at the top of the income statement with the headline figures. So total revenue for the second quarter hit $42.7 million.
Which is huge.
It is. That is an 18% growth rate year over year. But here is the critical data point for you guys listening. That $42.7 million, it beat the very top end of management's own guidance by $2.5 million.
And in a macro environment where, like you said, most SaaS and infrastructure companies are narrowing their guidance or just missing entirely.
Missing by a mile.
Yeah. Right. Beating the top end by that magnitude, it really suggests an acceleration in underlying demand that, honestly, even their internal forecasting models just failed to capture 90 days ago.
What's fascinating here is the flow through to the bottom line, though.
Exactly.
Because it's one thing to see a top line beat driven by, aggressive discounting or massive marketing spend. Or
buying the growth.
Yeah, buying the revenue. But that's not what happened here. Non-GAAP net income came in at $5.0 million, or about 8 cents per diluted share.
Wow.
And if you look at the exact same quarter last year, that figure was just $0.8 million. They generated massive leverage on that revenue beat. Adjusted EBITDA came in at $12.8 million, which represents a 30% margin.
30%? That's serious.
Right. And that 30% adjusted EBITDA margin is exactly where my initial skepticism kicked in, to be honest.
Why is that?
Well, when I read the transcript, I saw they expanded their EBITDA margins by 1,200 basis points year over year.
Oh, wow. Yeah.
Now, my first instinct as an analyst when I'm looking at a 1,200 basis point expansion in just a 12-month window is to assume they're either, slashing vital R&D, or they're just arbitrarily squeezing their current customers to make the bottom line look pretty for Wall Street.
Right. The classic short-term pump.
Exactly. But when you actually look at the OpEx, it only grew 6% year over year against that 18% revenue growth. So walk me through the structural mechanics here. How are they achieving a 12% margin expansion without hollowing out the core business?
Yeah, your instinct to check for R&D cuts or unsustainable price gouging is exactly right. You always have to check that.
Yeah.
But the data here points to a purely structural shift in their revenue mix.
Okay, a mix shift.
Yes. The margin expansion is almost entirely a byproduct of the B2 cloud storage segment effectively overtaking the legacy business.
The B2 segment, right?
So B2 segment revenue hit $26.6 million for the quarter, and that grew 34% year over year.
34%.
Yeah, and because their legacy computer backup business actually shrank by 2%, B2 now commands over 62% of total revenue.
So it's a pure operating leverage story then.
Pretty much.
The B2 consumption model has largely fixed infrastructure costs, at least up to a certain utilization threshold, right? So as that specific segment scales at 34%, every incremental dollar just drops straight to the bottom line.
Precisely.
Yep.
I mean, the gross margins on B2, once the underlying storage clusters are actually paid off, they are incredibly high.
Right, because the servers are just sitting there spinning.
Exactly. The structural change is that they are just no longer dependent on those slow-growing, flat-fee consumer subscriptions. They have transitioned into a true consumption-based infrastructure as a service model.
Which Wall Street loves.
Oh, they eat it up. As enterprise customers store more data, the revenue scales instantly without a linear increase in headcount or, operating expenses. That dynamic is what dropped OpEx as a percentage of revenue by 800 basis points down to 73%.
Which brings us to the specific catalyst for that B2 growth, because we really can't ignore the pricing lever they pulled.
No, we definitely have to talk about that.
On May 1st, they instituted a price increase for the B2 cloud storage offering. And management was very transparent on the call that this price hike added 8 percentage points to the B2 revenue growth.
And it layered $9 million onto the B2 annual recurring revenue.
Yes. My theory here is that this price increase was like the ultimate stress test of the hostage situation we talked about at the top of the show.
Oh, absolutely it was.
They raised prices, and the anticipated churn, it simply didn't materialize. In fact, they saw higher average revenue per new signup.
It was a massive validation of their competitive moat. I mean, when a utility-like infrastructure service raises prices, the immediate risk is customer flight, right? You expect people to leave.
Naturally. You think they'd shop around.
But Backblaze's pricing power doesn't exist in a vacuum. It exists in direct contrast to the hyperscaler egress fees.
The AWS tax.
Right. When Backblaze raised their storage price, their enterprise customers immediately ran the cost-benefit analysis. They looked at the slightly higher monthly bill from Backblaze, and then they calculated the networking fees required to physically move petabytes of data back to AWS or Google Cloud.
Plus the higher base storage costs at those legacy providers anyway.
Exactly.
And the math just overwhelmingly dictates that they stay. I mean, the cost of egress is so punitively high that eating an 8% price increase from Backblaze is vastly more capital efficient than migrating all that data.
Exactly. Even after the price increase, Backblaze remains aggressively priced compared to the legacy tier. Furthermore, they are still championing that architectural freedom by offering free egress in many scenarios.
Which is huge for onboarding.
Right, meaning new customers aren't afraid to onboard in the first place. But there's a secondary layer to this lack of churn, specifically tied to the AI sector.
Okay, let's hear it.
For enterprise AI developers, the cost of data storage, even after a price hike, is literally a rounding error compared to the hundreds of millions they are spending on graphics processing units, the GPU.
Right, those NVIDIA chips.
Yeah, the compute costs are so astronomical that a slight increase in storage costs barely even registers on their P&L.
That dynamic is the perfect pivot point into the actual story behind these financials, because the revenue beat and the margin expansion, those are just trailing indicators.
They are looking in the rearview mirror.
Exactly. The forward-looking narrative here is entirely driven by this AI infrastructure boom. You cannot read this Q2 transcript without addressing the multi-exabit elephant in the room.
CoreWeave.
CoreWeave. Here's where it gets really interesting. Backblaze announced a multi-year strategic contract with CoreWeave valued at $335 million.
It's just a staggering number.
It is. For context, Backblaze just reported a $42.7 million quarter, and they just signed a single $335 million contract.
Yeah, it is the largest deal in their operating history.
By far. And the immediate impact on the balance sheet is just violent. Their remaining performance obligations, the RPO, skyrocketed to $396 million.
Which is wild.
That is a $319.5 million jump in one single quarter.
The RPO explosion is, without a doubt, the single most important metric for a retail investor to internalize from this report.
Break that down for the listeners. Why is RPO so critical here?
So in a consumption-based software model, RPO represents the total value of contracted revenue that has not yet been recognized on the income statement.
It's money in the pipeline.
Exactly. It is your window into the future. It tells you the legal minimums that customers are obligated to pay, regardless of their day-to-day consumption variance.
Right, they have to pay it no matter what.
Yes. Adding over $300 million to RPO completely de-risks their near-term revenue projections. It provides a level of visibility that most infrastructure companies would kill for in this macro environment.
But the traction isn't even isolated to just CoreWeave, which is crazy. They also highlighted a 7-figure annual recurring revenue deal for a new tier of service called B2 Overdrive.
Right, the frontier deal.
Yeah, they signed it with a, quote, frontier artificial intelligence model developer. So they are locking in the specialized AI infrastructure providers, the neoclouds like CoreWeave, and they are simultaneously signing direct deals with the organizations building the foundation models themselves.
They're attacking both sides of the market.
They really are. I want to dig into the technical architecture here, though, because understanding why these massive entities are flocking to Backblaze requires understanding this concept of the capacity tier.
Yes, the capacity tier is everything right now. To understand it, you really have to look at how data moves during an AI training run.
Okay.
When you are training a multimodal foundation model, so ingesting massive spatial data sets, high-definition video, audio, the data requirements are just astronomical.
Right, exabytes of data.
Exactly. Now, the GPUs, like the NVIDIA H100s or B200s, they cost tens of thousands of dollars each. When those GPUs are active, they need data fed to them at lightning speed so they don't sit idle.
Because idle time is literally burning money.
Exactly. So for that active processing layer, AI companies use NVMe or flash storage, which is blazingly fast, but incredibly expensive and highly constrained.
Okay, let me posit a mental model here to see if I'm tracking the exact hardware limits on this.
Go for it.
Let's look at the AI compute stack like a high-end commercial kitchen at a Michelin star restaurant.
Okay, I like where this is going.
In this model, the GPUs are your master chefs. They are the ones doing the incredibly complex, highly valuable processing work.
That aligns perfectly. Keep going.
So the flash storage, the NVMe, that's the custom-built cutting board right in front of the master chef.
Right.
It is premium, highly limited real estate. When the AI is actively training on a specific batch of data, the ingredients need to be right there on the cutting board. It needs to be instantaneous.
Right. No delay.
But you cannot possibly build a kitchen entirely out of cutting boards.
Yeah, you'd go bankrupt.
It would be a catastrophic misallocation of capital to try and store petabytes of inactive training data on flash storage.
It would completely destroy the unit economics of the neocloud provider. The return on invested capital would just plummet.
Right. So you need a pantry. You need a massive, highly secure, incredibly cheap walk-in freezer where you can store exabytes of data until the exact moment the chef needs a specific ingredient.
It's a capacity tier.
Exactly. That pantry is the capacity tier. It runs on high-density hard disk drives, not flash. It is slower, sure, but it is vastly cheaper and scales infinitely.
And that's where Backblaze comes in.
Right. CoreWeave and these frontier model developers are using Backblaze as the pantry. They dump the exabytes of raw data into Backblaze, and they only migrate the necessary subsets to the expensive flash cutting boards when a specific training job is initialized.
Your kitchen model perfectly isolates why this $335 million deal happened. When neoclouds like CoreWeave first launched, their entire value proposition was built around GPU availability. They were entirely focused on providing the master chefs.
Right, just getting their hands on the NVIDIA chips.
Exactly. And as they scaled, they built out the NVMe cutting boards to keep those GPUs fed. But as the multinodal models grew exponentially in size, the neoclouds hit a wall.
They ran out of pantry space.
They realized they were missing the underlying capacity tier. They lacked the massive, cost-effective pantry.
And building that pantry from scratch isn't just about, buying a bunch of hard drives and plugging them in. It's an entirely different operational discipline, isn't it?
Precisely. Managing exabyte-scale hard drive clusters is a brutal operational challenge. You are dealing with the physical mechanics, the physics of spinning disks.
Which fail all the time.
Constantly. You have to write proprietary predictive failure analytics. You have to manage localized heat dispersion in the racks.
Wow. Okay.
You have to engineer massive data replication algorithms to prevent bit rot and build load balancers that can handle thousands of concurrent reads and writes without catastrophic bottlenecks.
It's a whole different ballgame than just running GPUs.
It really is. And Backblaze has spent nearly 2 decades optimizing the software that manages this specific, specialized hardware environment. CoreWeave looked at the capital and time required to replicate that expertise.
And they just said no thanks.
Right. They correctly determined that partnering with Backblaze for the capacity tier was the only logical path forward. Management actually sized this specific NeoCloud capacity tier demand as a $14 billion total addressable market by 2031.
$14 billion.
Yeah.
That is a massive TAM for them to go after.
Which brings us to the operational mechanics of the CoreWeave contract, because it introduces a completely new business model for Backblaze.
This is the really exciting part.
It completely shifts how we have to value their operational leverage. We really need to talk about managed storage.
Yes. When I read the transcript detailing how they are deploying this managed storage, it completely upended my assumptions about their capital expenditure curve.
It is the most critical strategic pivot in the entire earnings report, honestly.
How so?
Historically, Backblaze is a traditional cloud provider, right? They own the data centers, they buy the servers, and customers route data to them over the public internet.
Right, the standard SaaS model.
But the managed storage model flips that architecture entirely. Backblaze is taking its proprietary management software and its highly trained operational personnel and deploying them physically inside the customer's own infrastructure.
Okay, wait. So in this scenario, CoreWeave secures the physical data center real estate, right?
Correct.
CoreWeave buys the massive racks of hard drives, putting the hardware on CoreWeave's balance sheet, not Backblaze's.
Yes, that's key.
Backblaze just provides the bill of materials, telling them exactly which drives have the lowest failure rates based on their, 20 years of telemetry data. And then Backblaze personnel physically walk into a cordoned-off cage inside CoreWeave's data center, rack the servers, install the Backblaze OS, and manage the entire cluster remotely.
That is exactly the architecture. And from a financial perspective, the beauty of this model for Backblaze is that it is incredibly capital light.
Because they aren't buying the metal.
Because CoreWeave is bearing the capital expenditure burden of buying the physical hardware. Backblaze doesn't have to lever up its own balance sheet to support the exabyte expansion of the capacity tier.
That's huge.
It is. Backblaze is effectively monetizing its operational intellectual property and its software layer. The primary cost for Backblaze becomes just the specialized personnel managing that localized infrastructure, which paves the way for software-like gross margins at maturity.
It's a brilliant capital-light pivot, I'll admit, but I want to push on the underlying motivation here.
Sure, go ahead.
If CoreWeave is already buying the hardware, why not just hire their own specialized IT teams to run it? Why hand over a margin to Backblaze at all?
It's a fair question.
During the call, CEO Gleb Budman specifically cited sovereign cloud requirements as a massive driver for this managed storage approach.
Oh, yeah.
Connect those dots for me. How does global data compliance force CoreWeave into this managed storage arrangement?
So the sovereign cloud dynamic is kind of the hidden geopolitical layer of the AI infrastructure boom.
Geopolitics, really?
Oh, absolutely.
Yeah.
A sovereign cloud refers to compute and storage infrastructure that is physically located within a specific nation's borders and is subject exclusively to that nation's localized data privacy laws.
Like GDPR in Europe.
Exactly like GDPR. As AI models become deeply integrated into critical national infrastructure like ingesting local healthcare records, financial telemetry, and government data regulators are mandating that this sensitive data cannot be exported.
So you can't just send it to a centralized hyperscaler data center in Virginia.
Right. The data must remain sovereign.
Ah, I see the friction point now.
Yeah.
If CoreWeave wins a massive contract to provide AI infrastructure to, let's say, a European banking consortium, they have to guarantee the data never leaves Europe. Yeah. If they want to use Backblaze as their capacity tier, they can't legally route that banking data over the open internet back to a Backblaze data center in California.
Exactly. And that regulatory firewall is what makes the managed storage model indispensable. Backblaze can deploy its software and personnel directly into CoreWeave's compliant regional European data centers.
Oh, wow. It instantly solves the sovereign data requirement.
It does. The customer gets the strict localized compliance they need. They get the capacity tier physically adjacent to their sovereign GPUs to minimize latency, and Backblaze secures a massive capital-light revenue stream in geographic regions where they previously lacked any physical footprint.
That is it is a highly strategic workaround to global data localization laws.
It's incredibly smart.
It really paints a picture of a compounding ecosystem. The $335 million CoreWeave deal is roughly a 70-30 split between traditional platform usage and this new managed service component.
Right.
Then you layer in the seven-figure B2 Overdrive deal with the frontier model developer. The transcript mentioned that developer was hitting quota ceilings with their previous legacy provider, which just speaks to the artificial constraints legacy clouds place on high-throughput AI workloads.
They throttle them.
Yeah, they throttle the speeds. They even highlighted a six-figure deal with a conversational AI company that explicitly chose Backblaze to escape the egress fee hostage situation.
Which brings us all full circle.
Right. But they aren't just hunting whales, are they? The go-to-market strategy seems to be attacking the AI ecosystem from the bottoms up simultaneously.
Oh, definitely. The developer ecosystem initiatives are just as critical for long-term retention as the enterprise sales motion.
How so?
Well, during the call, management highlighted the release of a brand new software development kit, an SDK, written natively in TypeScript.
I noticed that specific call-out in the transcript. Why prioritize TypeScript? What makes that specific language so critical to the generative AI narrative?
Because TypeScript has rapidly established itself as the dominant programming language for developers building agentic AI workflows and generative applications.
Interesting.
Yeah, full-stack developers are migrating to AI, and they're bringing TypeScript with them. By shipping a native, highly optimized SDK for TypeScript, Backblaze is removing all friction.
So they don't have to build custom bridges.
Exactly. Developers can instantly integrate B2 storage into their new AI applications from day one without having to write custom API wrappers. And they paired this with the launch of GenBlaze, which is a generative media SDK, and they hosted targeted generative media hackathons.
It's the classic AWS playbook from 2010.
Oh, 100%.
You embed yourself into the developer culture. If a developer uses Backblaze for a weekend hackathon project because the TypeScript SDK is frictionless, and then that project scales into a heavily funded AI startup, Backblaze is already permanently baked into their core architecture.
You capture the next generation of enterprise clients before they even know they're enterprise clients.
That is a brilliant dual-track strategy. You seed the grassroots developer ecosystem while simultaneously retooling the enterprise sales force to hunt these massive contracts.
And the data shows this transformation is working. At the end of Q2 2026, they had 235 customers, paying them more than $50,000 annually in recurring revenue.
235. That is a stark contrast from the IPO days, where the average customer was paying, less than $500 a year?
Right, for just simple computer backup. It is an entirely different caliber of revenue now. That specific high-value over 50K cohort grew 57% year over year.
57%.
And the total revenue generated from that cohort grew 67%. They closed 4 separate deals valued at over $500,000 in this quarter alone.
And let me guess, all AI related.
3 of which were directly tied to AI workloads, yes. They have brought in heavy-hitting enterprise leadership, too. A new chief revenue officer, a new head of sales development, a new head of revenue operations.
So they are building out the enterprise muscle.
Yes. They have completely restructured the company to manage complex, multi-stakeholder enterprise sales cycles, and the RPO expansion proves it is paying off.
Okay, so with that kind of RPO locked in, how is management modeling out the next 18 months? Because you don't sign a $335 million multi-year infrastructure deal without it fundamentally altering your forward estimates.
You certainly don't.
This brings us to the management guidance, which is arguably the most critical piece of this deep dive for any retail investor trying to build, a realistic valuation model.
The guidance provided was remarkably aggressive, particularly in a macro environment where conservative forecasting is kind of the standard right now.
Yeah, everyone is sandbagging.
Right. But for the full year 2026, they raised their revenue guidance to a range of $172 million to $174 million. That is an upward revision of more than $10 million from their prior estimates. Concurrently, they raised their full-year adjusted EBITDA margin guidance to a range of 27% to 29%, which is up significantly from their prior view of 23 to 25%.
So they are accelerating top-line revenue growth while simultaneously expanding their profitability margins. That completely validates the operating leverage mechanics we discussed earlier.
Exactly.
But the thing that truly stood out to me when I was reading the call notes was management providing a highly unusual sneak peek into 2027.
Yes, that was very surprising.
Usually, companies guard the next fiscal year's projections closely until at least Q4, but they explicitly stated that they expect B2 revenue to grow by over 40% year over year in 2027, based strictly on the contracted demand they have already secured.
Providing that level of directional guidance for 2027 in the middle of 2026 is an immense display of confidence.
It's basically a flex.
It really is. They are signaling to the market that the execution risk on their core growth engine has been drastically reduced. When you look at the $396 million in RPO and the legally binding minimum spending commitments embedded in those NeoCloud contracts, management already knows mathematically that the B2 segment is going to clear 40% growth next year.
The revenue is just locked and loaded.
It's practically guaranteed.
But there is a massive operational reality we have to address here.
I know where you're going with this.
You cannot fulfill multi-exabyte contracts without buying an ungodly amount of physical hard drives and servers. And this leads us to a highly technical but absolutely vital warning from the Chief Financial Officer, Mark Sudan, regarding their capital expenditures, the CapEx.
If we connect this to the bigger picture, this is the accounting nuance that will define the stock's trading volatility over the next 6 months.
Yeah, this is super important.
Retail investors must understand the specific mechanics of this CapEx cycle, or they risk totally misinterpreting the Q3 and Q4 earnings reports later this year.
Let's break it down for them.
To build out the traditional platform capacity required to support these massive new commitments, meaning the portion of the CoreWeave deal that isn't the capital light, managed storage Backblaze, has to dramatically accelerate its capital expenditures in the second half of 2026.
Right. Sudan stated that CapEx will balloon to roughly 55% to 65% of revenue for the full year 2026.
That is a staggering percentage.
It is. That is a massive chunk of incoming cash going directly out the door just to rack new servers.
It is massive, but it is the prerequisite for infrastructure growth. You have to buy the drives to sell the storage. However, this creates a specific timing mismatch on the income statement that will negatively impact their gross margins in the near term.
Walk me through the math on that.
Here is the mechanical breakdown. When Backblaze purchases tens of millions of dollars of physical servers, they don't expense that cost all at once on the P&L. They capitalize the servers on the balance sheet.
Okay, standard accounting so far.
Right. But the moment those servers are deployed, they begin to depreciate the cost of that hardware over its useful life. And that depreciation hits the income statement as a direct expense against gross margins.
Okay, so if I am building a model right now, the depreciation expense starts hitting the P&L almost immediately after the purchase.
Yes.
But physically racking the servers, testing the clusters, migrating the petabytes of AI data, and ramping the customer's utilization up to the contracted minimums, that takes months.
Months, exactly.
So the expense hits today, but the matching revenue lags behind.
Exactly. There is an inherent structural delay. The CFO noted that there will be roughly a 2-quarter window where the new massive server clusters are actively depreciating, which adds a significant drag to the cost of revenue before the enterprise customers are fully ramped up and generating the matching revenue on that specific capacity.
So if I'm playing the role of the anxious retail investor here, and I'm tracking the stock, and the Q3 or Q4 earnings reports drop later this year, and I see gross margins take a, quote, few hundred basis point setback, as Sudan explicitly warned. Should I panic? Should I assume the pricing power has evaporated or the business model is deteriorating?
Absolutely not. You are simply witnessing the mathematical reality of capitalized depreciation front-running consumption revenue. It is the very definition of a temporary growing pain.
A good problem to have.
Frankly, it is the highest quality problem an infrastructure company can have. It means they are aggressively deploying capital against guaranteed contracted future revenue.
Okay, that makes sense.
Sudan reassured investors by noting that the CapEx break-even period, which is the time it takes for the revenue generated by a new server to fully pay back the physical cost of that server, is less than 24 months.
Oh, that's actually really fast for infrastructure hardware.
It is. And because Backblaze keeps these server clusters operational for well over 6 years, the lifetime return on that invested capital is phenomenal. That secures the long-term gross margin profile once the initial depreciation shock normalizes.
And they are managing the cash flow implications of this CapEx spike very carefully, too. To fund the hardware purchases without devastating their cash reserves, they expanded their available capital lease lines to over $150 million during the quarter.
Which is a smart move.
Yeah, it allows them to finance the equipment over time rather than draining their balance sheet with upfront cash purchases. Sweet Ann projected that by utilizing these leases, Backblaze will remain adjusted free cash flow neutral for the full year, despite the hypergrowth capital outlays.
It is highly responsible balance sheet management. We also need to briefly touch on the legacy segment, the computer backup business, just to complete the financial picture.
The old core business.
Right. This is the consumer and small business tier. Revenue here was $16.1 million, representing a 2% decline year over year. Management was very candid that this specific market is facing broad headwinds, and they anticipate continued single-digit declines.
But strategically, the legacy business is essentially decoupled from the core AI thesis at this point, right? It's just a stable cash cow.
Precisely.
Yeah.
It generates highly reliable, recurring cash flow with virtually zero required incremental investment.
And they just funnel that cash to the B2 side.
Exactly. That cash flow is being actively redirected to fund the aggressive CapEx expansion of the B2 cloud storage segment. The legacy business is the bridge that allows them to finance the AI infrastructure pivot without resorting to highly dilutive equity raises.
Speaking of equity, there is one final, somewhat wonky financial housekeeping item we must address for complete transparency.
The warrants.
The warrants. Attached to the $335 million CoreWeave contract, Backblaze issued $22 million in stock warrants to CoreWeave and filed an S3 registration statement to formalize it.
Yeah, we have to explain this because it can look scary.
Yeah.
So stock warrants give CoreWeave the right to purchase Backblaze shares at a predetermined price in the future. It effectively grants the customer equity upside in the company they are purchasing services from.
Which naturally raises a massive red flag for a retail investor regarding dilution. I mean, why give a massive customer the right to buy your stock?
While it does represent potential future dilution, issuing warrants in multi-year, 9-figure strategic partnerships is actually an established practice in enterprise infrastructure.
It is.
Yes, it structurally aligns the incentives of both organizations. Backblaze is betting its CapEx curve on CoreWeave's success, and now CoreWeave has a direct financial incentive to ensure Backblaze scales effectively as their dedicated capacity tier.
That makes a lot of sense. You want your biggest customer to want you to win.
Exactly. But more importantly, for the financial modeling, the CFO clarified the accounting treatment for this. The $22 million value of those warrants will be treated as contra revenue.
Contra revenue. Okay, so meaning the value of those warrants will be amortized and deducted directly from the gross revenue they recognize from CoreWeave over the life of the 5-year contract.
Yes. It reduces the net recognizable revenue reported on the income statement. So the $335 million headline RPO number will ultimately translate into slightly lower net recognized revenue as that $22 million is amortized against it.
I see.
It is the most conservative accounting treatment available, ensuring they aren't artificially inflating their top-line metrics with equity grants.
Okay, we have dissected an immense amount of complex financial and operational data here today.
We really have.
We've explored the massive revenue beat, the structural leverage driving the 30% EBITDA margins, the data gravity locking in the B2 price increases, the mechanics of the AI capacity tier, the geopolitical brilliance of the managed storage model, and of course, the depreciation lag that will temporarily drag down gross margins.
It is a phenomenal case study in navigating an infrastructure pivot. I mean, they're threading the needle perfectly.
So what does this all mean? Let's distill everything we've analyzed into a clear, actionable summary for you, the listener.
Let's do it.
Based on the data, the structural margin expansion, and the massive RPO acceleration, I take a firmly bullish stance on Backblaze.
I'm with you.
The transformation they are executing is staggering. Remind yourself, at its IPO, this was a company known for selling flat-fee, $500 a year backup plans to consumers. Today, they have 235 enterprise customers generating over $50,000 annually.
And growing.
They are signing multi-exabyte 9-figure contracts. They are deploying proprietary management teams physically inside the sovereign data centers of the most critical AI infrastructure providers on the planet. They have successfully transitioned from a consumer utility into an indispensable enterprise AI infrastructure player. They have built the pantry for the AI revolution.
They really have. And my actionable advice for you, the retail investor holding or evaluating this stock, is to ruthlessly maintain a long-term perspective on the income statement mechanics.
Do not get shaken out by a bad quarter.
Exactly. The most critical takeaway from our analysis of the CapEx cycle is to look past the temporary gross margin dips that will inevitably appear in Q3 or Q4 of 2026.
Right.
Those dips are a mathematical certainty driven by the depreciation of necessary hardware investments. They are not a fundamental flaw in the pricing power or the business model. The broader market algorithms might react negatively to a headline margin miss later this year, but you now understand the mechanics underneath it all.
You have the edge.
The true North Star is the 2027 revenue visibility. With nearly $400 million in RPO mathematically locking in B2 growth of over 40% next year, the execution risk has been drastically minimized.
It is a masterclass in skating to where the puck is going in the AI era. But before we close out this deep dive, I want to leave you with a final unaddressed question to mull over.
Ooh, right.
Something not explicitly detailed on the earnings call, but it's kind of the logical endgame of this entire thesis. Think deeply about the managed storage model.
Okay.
Backblaze is now embedding its proprietary software and its highly specialized operational personnel physically inside the cordoned-off data centers of major AI neoclouds like CoreWeave. They are becoming inextricably physically linked to the core architecture of the generative AI boom.
The integration is becoming intensely codependent.
Highly codependent. So the question you have to ask yourself is this. As these neoclouds and frontier model developers scale up to handle tens of exabytes of data, and as owning a cost-effective capacity tier becomes the defining factor in their own profitability, how long will it be before a giant hyperscaler or a massive neocloud realizes that paying Backblaze a margin on a $335 million contract is just inefficient?
This is a great point.
Right. How long until one of these giants decides to just acquire Backblaze outright, simply to secure exclusive ownership of that vital proprietary software layer and the operational talent that runs it?
Consolidation in the AI infrastructure layer is inevitable, and a capital-light, highly optimized capacity tier would be a prime strategic target for any of them.
We started this deep dive talking about the hidden taxes and hostage situations created by legacy cloud providers. It's a complex, technically dense landscape to navigate as an investor. You have to decipher contra-revenue accounting, RPO explosions, CapEx depreciation lags, and the physics of data gravity.
It's a lot to take in.
But when you break down the mechanics, when you understand exactly why the AI ecosystem desperately needs a massively scalable, cost-effective pantry, the financial trajectory of Backblaze becomes incredibly clear. The vital signs of this infrastructure pivot are stronger than ever.
An exceptionally healthy underlying business, provided you know exactly which data points to measure.
That is all for today's Talk Tickers Deep Dive. Keep scrutinizing the data, keep looking past the Wall Street jargon, and we will see you on the next one.